Ark Capital Management explains why they think the U.S. may already be in the middle of a recession. This is Bloomberg. Bloomberg guests reacting to the Fed rate pause overnight. I want to bring in Saed Abukarsh. He's the Senior Executive Officer at Ark Capital Management. Saed, how much additional tightening are you expecting from the Fed, given what we heard yesterday?
Look, I think it's clear the Fed's going to go for another quarter point in the next meeting. Now, whether they actually follow through in the year, in September or later on in Q4 is still yet to be seen. I think one of the clear things that Powell made clear was we're still data contingent and we still have to see what core inflation looks like. Now, he's leading into the SEP, which actually he's lent into last year, and that's what gave us the confidence to be at 4.25 in terms of terminal rates. Now, they haven't deviated a great deal from that. But I think there's two sides to the story here in terms of what Powell is saying. One thing is essentially he's taking away the equity market's carte blanche to rally nonstop on the basis of potential cuts in the coming quarter or 2 quarters. I mean, he's taking it off for some time. So what I think we're looking at really as is they're giving a warning, in essence, to the idea that potentially that we're going to cut once we're done. That's one thing. We know, looking back from last year, that they're looking at 3 quarters of consecutive decline in core inflation before they actually assess the potential of dropping rates. Yeah. I think what's also a good takeaway here is the concern that Jay Powell had for unemployment, the surprise the committee had for unemployment, leads me to believe that they've changed their idea of what actually a recession looks like. So I
want to actually pick up on that because Jeffrey Gundlach made some comments and he said he's not expecting any rate hikes from the Fed at all anymore. How vulnerable do you see the U.S. economy at the moment in terms of the potential of a meaningful recession?
I think what we began this year, or I think last year, and there was a lot of pundits talking about hard landing and then soft landing, and we were of the belief soft landing was more probable outcome. I think what we're looking for now, I think what the Fed and Powell are definitely targeting, given their language right now, is more of a technical type of recession, where they actually see growth still just much slower. And I think that's what they're aiming for. Now they're battling two fights here, and the core fight is inflation, it isn't growth. So I think looking more towards a technical recession, barring any extraordinary risk-off market, is where we're actually heading towards. And that's, I think, where Powell has confidence in probably raising rates another quarter to 0.5 point in the next 2 quarters.
I mean, a rise in real yields when inflation is descending means the economy is holding up. And I was looking at some of the recession-sensitive stocks, and they rallied. I mean, I'm talking about Nike here. I'm talking about WeWork. I'm talking about the semiconductor index.
Well, I think
that doesn't necessarily add up with what you're saying.
I think what Powell, the takeaway from the Fed is the consumer has been strong. The main weakness in the economy, or the slowdown in the economy, has been based more in housing and the subsidies of housing. So I think that's where we're actually looking for growth. I think the consumer is still strong. Debt levels are not at great levels yet. The consumer came out of COVID with a lot of excess capacity, and I think that's what they're playing into. Now, the idea still is here is we still have a great deal of liquidity out there, given the QE that the Fed has put into place over the past few years. I think QT will play out over a few more years. And I think that's something to look forward to in terms of what the reduction of the Fed balance sheet will look like over the next few months. And will the Fed actually, if the Fed really wants to tighten more aggressively, they can obviously increase their QT pace, which would actually be further indication to the market that basically the Fed wants to tighten credit conditions. So we could see a situation where a quarter point, 0.5 point, and QT addition over the next few quarters.
Just circle back to the European story, because I know you spent quite a bit of time in the G10 FX space.
That's right.
On a tactical and strategic basis. How do you position ahead of today's decision from the European Central Bank?
I think one of the core issues here with Europe, I think, is Europe is definitely lagging the U.S. in terms of what their policy should look like. The U.S. was much faster. I think the Europeans now have indicated that there will still be additional hikes. I think they will follow somewhat with the U.S. in terms of what their pace will look like. But I still think that that Powell, the Fed, has actually now given us a very clear spread in terms of differentials that basically put the EU at a back step here in terms of what they can do. I think the Europeans will definitely sound more hawkish. I think that, but the pace will not be the same as the Fed has. The Fed now has put in more expectations into the next 2 quarters. I think that we'll still see the euro decline back to probably 103, 102 this year. This is our core view. But in terms of pace, I think definitely the ECB will run behind the Fed.
Saed, great to get you to weigh in on some of these themes. That's Saed Abukarsh. He's the Senior Executive Officer at Ark Capital Management. We still have much more to come on the show. This is Bloomberg.